So the LGFA was created basically through a need. Councils around the state in the early 80s were really struggling to find finance from banks, and there was a bit of a credit crisis on it at the time. And what actually happened was that a whole lot of smart individuals got together and decided, why don't we start this thing called the Local Government Finance Authority, and so that we can borrow money at will and so forth. I think anecdotally, people said they had to go, maybe West Torrens Council had to go to 4 different banks to borrow $40,000 to buy a truck, and they thought, this is crazy. We need to be able to borrow money at will when we need to. So that's why we were created. And sorry, is that someone with a question at all? Sorry?
No.
That's fine, thanks. And why use the LGFA? Well, there's a few reasons to use the LGFA over banks, because you don't need to use the LGFA. Other states like Queensland and so forth, they need to borrow money from their state government, their councils. But here in South Australia, you don't have to use the LGFA, but every council does use the LGFA. And the main reasons is that each year we actually pay a portion of our profits as what we call a special distribution. Last year we paid $2 million, and we've paid $54 million since inception. That $2 million is split on a pro rata basis, meaning the more you use us, the more money you actually get back. So some of the bigger councils do get the lion's share of the distribution because they do borrow a lot of money from us. The next reason is we have this thing called the tax equivalent regime that some of you may have heard of. So we pay tax just like a normal business would in Australia, but instead of that money going into the federal government, it goes to the state government and then actually flows back into the local government sector by this thing called the Local Government Research and Development Scheme. And we've actually paid tax equivalents of around about $36.9 million, which since inception, which has been used for local government research and development purposes. And the last reason I say to use the LGFA is that when you have deposits with the LGFA, 100% of those deposits are guaranteed by the state government. So it's very different to if you had money with National Australia Bank or Bendigo Bank, for example. Not all of it's guaranteed by the state government. It's only basically, it is guaranteed by the federal government, but only the first $250,000. So that's the reason we go to most councils. But you're not the only council in the state that uses. As I said before, every council in the state either has a deposit or a loan with us. So we definitely have definitely have a good hold into the sector, because I think we are different. How do we fund ourselves? So many of you may understand a bit about banking, but basically a bank, if it needs to lend money to a client or to a customer, it needs to have that money. And the main way we fund ourselves is from, believe it or not, there are some councils and other entities in the state that are actually have deposits with us, and that's about 500 mil of our 800 mil worth of loans is from the local government sector. And the other 300 mil is actually we fund ourselves with 75 mil worth of our own capital, and the other about 225 mil comes from the state government. And we have lines from the state government of South Australia, which is really great for us and makes sure that we can provide low cost funding to councils around the state. LGFA wants to be a responsible lender to the sector, and that's something I took over in 2020 as the CEO. And basically what it means is we want to make sure that we lend in a responsible manner to the councils. And I guess the best way for us to understand whether we can lend responsibly to a council is that we have to assess the financial sustainability of the council. Now, I'm sure that's something that Beck and her team have spoken to you a lot about in over the last few years, or the last year at least, since you actually came onto the council. This is your first term. So sustainability basically means, are you an ongoing entity? Can you pay your bills? Can you keep going into the future? And I like to say too, are you going to leave the place in a similar to better place for your children and so forth too? So being sustainable means basically paying for the services that you're actually using at this point in time. We'll go into a bit about that now as well, about what we mean by financial sustainability. So sustainability is something that we focus a lot on here at the LGFA. And what are the best ways to assess a council's financial sustainability? Well, there are these 3 key ratios that that we spend a lot of time focusing on here, and they're listed up there for you right now on the slide, which are the operating surplus ratio, the net financial liabilities ratio, and the asset renewal ratio, sometimes called the asset renewal funding ratio. Those ratios are really good for people that are time poor who are on council. Very quickly, you can work out what the position of the council is by just assessing these three ratios, which form part of your financial statements. But what you've probably seen from the work that Rebecca and Dion have actually given you is that in a lot of their long-term financial plans, those ratios are also stated there. But I think personally, the most important one of those ratios is the operating surplus ratio, the OSR, because the operating surplus ratio basically means, in a way, are we bringing enough income in to cover our expenses? And if you've got a negative operating surplus ratio, it means you're not bringing enough income to cover your expenses. Now, you can run a negative operating surplus ratio for a short period of time, but if you have prolonged operating surpluses, thank you, Natasha. It basically means that in the end, you're actually spending more than what you're actually earning, and you will find yourself in a hole at some point in the future, because you basically, you may be degrading your assets to get to that point. You may be borrowing money to get to that point, and then there's only so much of that you can do. And that's why I think it's the most important ratio. And we'll talk a little bit about some of where we've seen you and where we've seen some of our concerns with you guys at the moment. But we'll talk about that a bit later. But what we'll talk about now is another really good key financial ratio to understand is the net financial liabilities ratio. And what that ratio is trying to do actually is showing you how much debt does your council have compared to 1 year's total income, okay? So if you've got 100% NFL, it means you owe at someone like that, like LGFA or some other lender, one year's worth of your income. So there is some literature out there from the LGA, your local government association, that talks about, okay, what are some of the levels of debt that you can have? And the advice they give is quite broad. It is between 0 and 100%. Now, some may say it's not particularly helpful, but what it does do, the range is so wide because there's so many different councils all across the state. There are councils that are quite stagnant, there are councils that are growing. And I think that's why the reason is the range is so wide. So, but what I'd say is if a council's at 100% net financial liabilities, that some of your plans that Fiona showed us for illustrative purposes would be, some of your ratios will be pushing up around those 100% net financial levels, which is quite high and very high for a small council. And so that's why you need to ask your team, why are we at these levels? And that's what's the questions you need to ask your finance team, Beck and Dion, why you're at these levels. But sure, the reasons why are quite evident from the discussions you're going to have later tonight about some of the possible levels that your net financial liabilities will need to go up. But they are quite high levels of debt for a regional council.
I'd just like to add to that. So it is such a wide range, and obviously it depends on the maturity of the council, on whether it is a growth council. There are some councils there that might have a really high net financial liabilities ratio around that 100% level because they need to build infrastructure for a growing community. So, for example, they're building the roads, they're building the waste management schemes, etc. And then over time, the strategy is to pay that down. A lot of councils will ask us, well, what is the average net financial liabilities ratio? Or how can we compare ourselves to other councils? And so across the sector, there's obviously a huge variation, but we would say that on average, a net financial liabilities ratio that we have seen is between 40 to 60 odd %.
And that sounds about right, Natasha, so that's good to know. So yeah, so usually we see levels of debt around between 40 and 60% of 1 year's income, okay? At the moment, your council is has quite low levels of debt, net debt, because at the moment you've got about $3 million worth of deposits and about $3 million worth of loans. So your actual net financial liabilities right at this particular point in time is 0. But as Dion and Rebecca have told us, some of that money is earmarked for particular projects that haven't been done yet. So you probably will have a level of debt already, even before some of the stuff you're going to consider later tonight. The next one I'd like to talk about quickly is the asset renewal ratio, and it's something that Tumby has done relatively well over the last few years, is actually trying to keep up with your asset renewal. What I'd say to councils is, what you want to ask your administration is, if your asset renewal ratio is below 100%, it means you're not committing to the renewal that you have inside your asset management plans. And so that's a good thing to know. If you're below 100%, why are you below 100%? And if you aren't, how are you going to try and catch up some of the renewal that you need to do to keep your council area functioning well?
And I'd add to that also, that asset renewal funding ratio. As a lender, we do look at this ratio quite closely. Sometimes when there's a low asset renewal funding ratio, which means that the council is not spending enough on asset renewal, so fixing or maintaining the quality of your roads and your footpaths, for example, as per the asset management plans that are in place. So what that's an indication is potentially a degradation of assets, and over time it can be a sign that a council is struggling with cash flow or using that cash for other purposes. So we do like to see, on average, that level close to 100% or close to what's in your asset management, council's asset management plans, because that really looks at all of the council's different assets, whether it's your roads, your buildings, all of the assets that the council has, and it has a plan and a goal there on how much will be spent for the renewal of those assets.
So the next thing that I say to a lot of councils as well is that another good way to look at the sustainability or the financial sustainability of a council is to look at their long-term financial plan. Now, I know that there is you guys are having a meeting tonight to look at some of the assumptions that you're going to place into your long-term financial plan. But LGFA, and Natasha is our Director of Lending and Treasury, Natasha will then go in, and before she does a lend to any council in the state, we'll look at the long-term financial plan and assess their sustainability, mainly focusing on, in my opinion, is the operating surplus ratio. So it is the main driver for us here. If the operating surplus ratio is negative, it's pretty hard for us to approve a lend. And what we like to see is that the operating surplus ratio is what we say is positive over the life of the plan. And if it is negative for a short period, then we want to know when is it going to get back into positive and what are the strategies of the council. But Natasha will talk about that in a little bit more detail a bit later. Another good thing for a council to focus on is your asset management plans and valuations up to date? If they're not, then it can give you surprises. Basically, what we've seen since COVID is we've seen the valuations of existing assets increase quite significantly, and that means that the cost to replace them or to renew them has also increased as well. So if your asset management planning is out of date, then it can cause you problems for a council. So it's a really good thing for a councillor to actually ask their management team how valid and how new how recently they have valued their assets. Now, from my understanding, this is something that Tumby Bay is quite good at, and something that Dion is very vigilant with and has brought into your planning along the journey. So we'll keep moving tonight so we can get onto any questions and any other stuff that comes along. But here I'll pass over to Natasha now. So Natasha does the lending piece for LGFA, so she's very aware of our credit policy, and she's just going to run you through what she looks at when she looks at a loan application.
Thanks, Davin. And just to extend on what Davin has been speaking about as well, we have a credit policy that basically looks at your past operating performance to really illustrate what's been the journey for the council so far. There are some specific metrics that we look at in isolation as a snapshot to really assess at a point in time. So looking at your annual report, so council's last financial year's annual report, we'll look at as a snapshot at a point in time at things like what was the net financial liabilities at 30 June 2023, what was the operating surplus ratio, and these are all found in the annual report, the asset renewal funding ratio, and then we also look at, well, what available credit lines do we also have outstanding to the council, and if the council was to use all of the pre-approved credit lines that we've already got in place, what would that net financial liabilities look like in a worst case scenario. We also look at the interest expense to ensure that that the council can afford the interest repayments based on the financial metrics and borrowing costs that the council has at that point in time. But in addition to that, what we really focus on, and what Darren was talking about earlier, is we really do focus on those long-term financial plans. So it is really crucial, and as Rebecca said earlier, when looking at the assumptions that are fed into that long-term financial plan, it's really important to use that as a live tool to really paint the picture on the financial sustainability. What does the council, what do those key financial metrics look like in the journey as the years go on for that 15-year period that Beck mentioned?
And just to say too, in the long-term financial plan piece, you know, it is a statutory requirement to update your long-term financial plan every year, and I know that Dion does that on a regular basis. But you know, it isn't just the thing that you should just have on the actual on the bench gathering dust. The way that you're considering to use it tonight, to look at the scenarios that you possibly could look at in regards to seawall, jetty, and so forth, it is a good way to actually look at it. That can be a good live document to let the council and the community understand what the true cost and what the true income that's required to actually to fund a large asset renewal, or a large renewal of your asset large asset renewal projects that you may be considering tonight.
Yeah, exactly. I think where we've been able to help our customers with regards to looking at options for borrowing is when we have looked at that live document and we have looked at the assumptions that are fed in to give us a picture of what that financial situation looks like for the council in the future. As Davin said earlier, we are focused on that operating position, because at the end of the day, we would like a council to aim to be breaking even on a longer term basis. We do understand that there are times that there are deficits, and we do monitor that, but what we look for in a long-term financial plan is a strategy. We've been presented at times with a long-term financial plan without a strategy of getting out of the financial deficit position. So what we're really focused on is a strategy if a council is experiencing difficulty, whether it be their operating position or whether it's large amounts of debt, or it could even be that the council is not keeping up with asset renewal. Then we use this long-term financial plan document to give us an indication on what to expect in the future. And we sometimes use, so there are cases where if a council is experiencing some challenges, we may look to put financial covenants or loan covenants on a loan that will talk to the council's adopted long-term financial plan. Because what that will do for us is it means that the council will be accountable for the decisions that have been made when a council adopts a long-term financial plan. We do understand that things change, and sometimes a long-term financial plan is exactly that. It's a plan, it's fed in with assumptions, and that obviously gets reviewed on an annual basis. When we do place loan covenants or financial covenants on a loan, we do look at that annual review to just ensure that the council is still focused on that financial sustainability over the longer term.
Natasha, do you have a slide on the covenants piece coming up? I think it is.
There it is.
Yeah,
I'm a bit slow.
So financial covenants is something on special conditions that we place on loans. That basically is a bit of as it's saying here up on screen, there's a promise, an agreement, a contract between parties. And what we usually do is that we align the covenants to your realistic and adopted long-term financial plan, as that Natasha has got down the bottom. So what it means is we're trying to say to you, as a lender, especially when debt levels get to high levels, which is what some of your proposed or suggested planning that Dion sent through to us get to, we'd be thinking that we would need to put special conditions on some of the lending that we have seen in those proposed plans, considering the levels of the debt that are required for the seawall and the jetty, for example. And I guess, it's not just about the high levels of debt, it's also about the operating deficits that are placed through the plan as well. So it would definitely be, it would probably be some of the things that we'd have to consider at that point as well.
I think I'd also add that loan covenants or financial covenants is it's a very common thing in commercial lending. So if any of you run a business or have borrowings through a business, there are often financial covenants in place with regards to debt levels or interest covenants, etc. What we try to do to work with our clients, to work with the councils in local government, is rather than just placing a flat financial covenant on a loan, is we try to work with the council to align to what you're saying that you're going to do. So that's why we look to align to the council's long-term financial plan. It's a means for us to monitor that you're, as a council, when you're adopting a long-term financial plan to aim towards financial sustainability, that the council continues to be focused that that is the end goal. We want to be a financially sustainable entity, and there may be some challenges in the years ahead, but the strategy is to turn that position around so that we can get to a manageable position in the future. So, as I spoke about earlier, we have a credit policy that looks at specific metrics at a point in time. Obviously, green usually is a good thing and red is usually not so good. There's a note there to say if a ratio is red or if it's exceeded, that does not mean that a loan will not be approved. We use this as an indication to say, oh, okay, so you need to ask some questions to the council. So, for example, that operating position for the 22-23 year was a deficit position of 17%. So in turn, we'd say, okay, well, what drove that? What was done? Was that close to budget? Was there some surprises along the way, etc.? And we try to understand. We also look at the council's history to say, well, has this been a reoccurring case? Is the council focused on turning that around? And also, in the long-term financial plan, is this predicted to remain a large deficit position, or is there a strategy to turn that round to a surplus position?
And we realise here on screen you can see that large operating margin of minus 17% last year. We know that was primarily driven by the repairs to the Port Neal jetty, I think it was, from memory. And so that's situations where that expenditure on a lease asset had to run through your profit in that year. It couldn't be capitalised like it could with other assets. But still, that is money that you've actually spent that probably is deteriorating your operating position. Is money spent that may or may not have been in the budget position.
Those other metrics there, as I explained earlier, I won't spend so much time on it. We look at how much debt you've got compared to 1 year's total income. We look at your available facilities, and obviously we look at your interest expense. Again, I mentioned this already, we also look at your historical performance. So those key metrics that we spoke about earlier, we look at your operating surplus ratio and we say, okay, well, what's the journey been over the last 3 years? We actually look at the last 10 years just to paint a better picture. But I think think this one we may have obtained through your annual report. A lot of councils do report that 3-year period anyway to paint that picture. So it is really useful as an elected member or as a person part out of the community. This does give, it's a good way to paint the picture and to indicate, well, what's the journey that the council has been over the last couple of years. We can see that in terms of that operating position, the council, Tumby Bay has had challenges over recent years. 22-23 was a large deficit position. There was a surplus position in 2022. In 2021, there was also a small deficit position, but in previous years, there have been small deficit positions as well. For the net financial liabilities ratio, Tumby Bay have never had large amounts of debt. So in terms of that ratio going from 15% to 1%, even at 15%, they are low levels of debt compared to other councils in South Australia. And that asset renewal funding ratio, as we said earlier, 22 and 23, or specifically 22, we really did experience a lot of supply chain shortages, etc. And we've actually seen over the last couple of years around South Australia, a lot of councils struggle to achieve 100% asset renewal due to contractor availability and supply chain shortages. On the flip side, what we have seen is a lot of councils are predicting greater than 100% asset renewal for this year that we're in at the moment to catch up on the backlog of asset renewal over previous years. I would say that on average, on the councils that we've looked at over the last 12 months, on average, there would be around that 70 to 80% of asset renewal. So I think Tumby Bay is around where most other South Australian councils have been over the last 12 months. But historically, the council has renewed assets as per your asset management plans and has actually done it quite well historically. Now what we do, this particular slide just gives, I apologise if the writing is quite small for you there, but it does give just a snapshot. This is a little bit dated, it's from the 8th of February, of the financial snapshot of the council as at the 8th of February. Some of the terminology is a little bit different to what you find out when you're looking at home loans, etc. But basically, this summary says that the council has $3.2 million of deposits sitting with the LGFA. There are debenture loans, $3.2 million of debenture loans. Debenture loans are what we call fixed rate loans that amortise. Generally, they amortise over the life of the loan. So what that means is they're fixed rate loans, so you can't, with that deposit that's sitting there of $3.2 million, you can't just use that money to pay off a fixed rate loan. They are fixed for the life of the loan, and over that time frame, the principal reduces to zero. The other addition there is a cash advance debenture. They're generally our variable rate loan facilities. District Council of Tumby Bay has a variable loan facility of $740,000 that's not currently being used, and that makes sense because the council has deposits in the bank. If there was a cash advance debenture that was being used, I'd be saying potentially, you don't need to borrow that because you've got deposits in the bank. But this is the current financial situation of the council as at a snapshot point in time.
We would be recommending, I guess, that you would utilise your deposits before borrowing any more money from us is what we would recommend, no matter which way you go with your decisions that you may be considering later tonight. So I think that's where we do see that most councils around the state will spend or utilise their deposits before they start borrowing money.
And that's what we generally recommend. If we see a council that applies for a loan through the LGFA and I see that there are deposits in there, I would say, well, prioritise using those deposits and you can come to us at a later point in time and borrow when you need it.
And I do know, speaking to Dion prior to the meeting, that some of those deposits are earmarked for projects that are already committed anyway.
And if that's the case, then at the time that the council needs funds, then those deposits will obviously be majority of that will be used by the time the council needs funding. I guess the only other note that I've put there is when we look at a lot of these financial metrics, we do consider both your rate revenue and your total income. And for a council, I guess, when you're looking at millions of dollars, sometimes when you're looking at borrowing levels, it does become a little overwhelming. I think the main thing to keep in mind is the rate revenue. So the revenue that you are getting from your general rates is around $6 million a year.
And just to reiterate that, that is one of the lowest rate revenue councils in the state. So, to put it into terms, some of the numbers seen in some of the proposed stuff or actual use for informational purposes from the administration, some of those loans are talking about one whole year's of revenue income that you're talking about here, which is a lot of money in relative terms for the council.
So we do usually use this opportunity to talk through the council's long-term financial plan, but given there are some decisions that are going to be made or going to be considered in tonight's meeting, we thought it's probably not relevant to be talking about the current adopted long-term financial plan given the amount of uncertainties in the decisions for the future. What we did want to touch upon, obviously, is the fact that the council is experiencing challenges, and that is seen directly with the historical operating surplus ratio and the expected operating surplus ratio for 2024.
And what we really wanted to highlight here on this slide is that, as you can see, the 2024 budget is showing a negative 9.1 operating surplus, a negative 9.1% operating surplus, I was right the first time around. And then you can see here, by the time we've got to budget review 2, you're in negative 24.6% operating surplus ratio. And we understand there's the variations that are listed below, why there is a big changes between budget and budget review 2. This is the thing, I guess, if we were putting covenants on a loan for considering the seawall, considering the jetty and so forth, we really want to be within the budget levels, the budgeted operating surplus ratio that you've actually put in there. And even at 9.1, that's quite a large deficit in terms from what we see. If anything below 5%, is generally the case where we need to get board approval on loans. This is already quite a tough lend, but as you can see, by the time you've got to budget review 2, you're already at a negative 24.6% operating surplus. So we just want to highlight here that we put covenants on a loan. We really want the council to live to that budget. And if there are additional expenditure, we'd hope that the budget could find additional cost savings to implement and bring them to the budgeted position that they're saying. Otherwise, this could end in a spiral where basically the council is not bringing enough income in to cover its costs.
So we'll really wrap it up there and open it for questions. We thought it would be relevant. Generally, people are interested in where our interest rates are. So currently, we have that variable rate facility. It's sitting at 6.15% at the moment. That is obviously a variable facility that is subject to change according to what the Reserve Bank does. So that has increased quite significantly over the last 12 months. Obviously, the market expectations with a slowdown in inflation, we are hopeful that interest rates will go down into perhaps the end of 2024 to 2025. That's when most of the market expectations are. But again, that's where, as the variable rates are subject to change. Those credit frontier rates that are listed there, they're fixed rate loans, so they're currently sitting lower than that variable rate facility because those fixed rate loans generally look at what are the expectations of where rates are going in the future. Because
some of the major banks think that we probably will be about 0.75% lower by about this time next year than what we are currently. But time will tell as interest rate markets are moving every day.
That's right. No one's got a crystal ball, but I think it's useful to note that 12 months ago, those credit frontier rates were significantly higher than the variable rate, and that's just flipped because the Reserve Bank has done what the market had expected at the time. So I know that was some fairly heavy language that we were using with regards to what we look at. We are open for questions, whether it be now or at a later stage. We're again happy to share this presentation as well.
But just to, if you want to go to the last slide, Tash, I might just sort of close up before we get any questions.
Just to add, this is
just some extra information.
Extra information on our website. If you want to know specifically about our products or our, I guess, how we view responsible use of debt, feel free to access that. But that's it. I'll just minimise that so we can actually. I think we're back in.
Yeah, so we can just stop sharing. Yeah, that's fine. Thanks.
Okay.
So hopefully it's still online there as well, Tumby Bay, but that's the end of our presentation tonight. As I said, there are definitely some challenges there with the council's operating position, and we did want to highlight that, and it would make it a challenging lend for any lend that we did for Tumby Bay Council, and that's why I guess special conditions and stuff would need to be considered. We're happy to take any questions from the councillors or the administration.
Thanks, guys. Good presentation, and always helps to kick off our budget and long-term financial planning process, getting that background. And just like to note that, as a group of elected members, you've obviously, previously committed to, getting the council back into that operating surplus position, notwithstanding the current challenges. So it's certainly the position that you took last year and the previous council the year before. Are there any questions from any of the elected members that you've got of Gavin and Natasha or any of the administration regarding what you just heard?
Yeah, the fact that the jetty is not our asset, does that come into any of your reckoning?
No, it doesn't, because in the end what we do is when we secure the lending to the council, we take what we call a debenture charge over your rate income. So we don't take it over, unlike some of the banking that you may have seen in your personal lives where a bank will generally take a charge over the asset. What we take is a charge over your income. So what we're saying is that we will take a charge over your general rate revenue. Actually, it's actually your general revenue. So it's basically any revenue that comes to the council will be taking a charge over. But there is one issue with that I'm speaking with Dion and Rebecca about too, councillors, is that obviously because it's not your asset, any dollars you spend on it goes straight through your operating position on day one. You can't capitalise it like you can a lot of your other assets as well.
And we understand, that is an operating expense. If it was your asset, then, it would be a capital expense. And so when you're looking at capacity to borrow, the fortunate position the council is in at the moment is that you have very low levels of debt. And so in terms of capacity to borrow, there is capacity to borrow. But what needs to be considered is the level of debt that's being, or the projects that are being considered. What we do see is when there are high levels of debt, what we generally suggest is looking at staging projects or looking at a strategy to limit the debt load to be so high to begin with, and look at just chipping away at the projects little by little so that you have a manageable level of debt. Obviously, the operating position is a challenge, but we have seen over recent years, the council has a strategy to turn that around. It is just, well, when there are, extra expenses that need to be considered, what does the council need to do to try to limit the variation between what's budgeted and what has happened during that process of actually progressing the capital program.
Are there any other questions at all that we can answer today?
Sorry, Judy.
Well, I don't know whether you've covered this. If we, just using if we had a loan of say 3 million or whatever, like just using that as an arbitrary figure, and by some means we were able to pay that back sooner, that there's no penalty with that. That's just, is that something that we're able to do?
That depends on the product that you choose. If you had a fixed rate, say a 10-year loan, and you wanted to repay it, yes, there could be a penalty involved. It's not a penalty, we call a market adjustment. Just like if you were with a bank and rates dropped significantly and you're in a fixed 5-year home loan, the bank would charge you a break fee. Well, we don't call it a break fee, we call it a market adjustment because we'll need to break a derivative swap product with one of our banks that we've got into that have made that a reality. But if you're in a cash advance debenture variable product, no, you can repay that at will. So if you had borrowed, say, $3 million to do that and you got a grant, an additional grant for a particular project, yes, you could use that money to repay that debt straight away, just like a variable rate home loan.
I add that there is the ability to break loans with LGFA. It just depends on, where interest rates are. So there may be fixed rate loans that may give you a benefit to break. But obviously we would look at, if there's unexpected, you did get grant funding and you borrowed money, it was in a fixed rate and there's no need to have the debt, we absolutely will look at the lowest cost possible for you to break that if there is a cost, or if there's a benefit, you'll get a benefit paid to you depending on what interest rates are.
So it depends on whether you are on the interest rate cycle.
Excellent. I don't think there are any other questions. Devon and Natasha, are you staying with us for the rest of the meeting, or are you intending to head off?
Yeah, we're going to shoot off if that's all right,
Yeah.
Beth, because we think it's something now that you can discuss. Obviously, we think we've sort of framed what the process is for us, and I guess what I just wanted to pass on to the elected members is just that it's just your borrowing capacity is very much constrained by the small size of your council and the small rate base that you have. Okay, so having the ability for you then to service that debt and raise enough money from your actual community to cover the costs and the ongoing costs of the project. Now, I don't want to get into it too deeply tonight, but a problem with funding a jetty is that there's not much tangible income for the council to collect from that. I understand there are community benefits, and I've seen the LGAs press on this topic about jetties, and I've seen Tumby's, how much the Tumby jetty is loved by the community. But unfortunately, from a council point of view, it is an asset where it is an expense asset, and not a lot of income is attracted back to the council. So it becomes, how else in the community are you going to raise enough money to fund the borrowing and essentially pay back that debt over a period of time? And then there's a challenge that I guess that your council is facing right at this point in time.
Thank you. Well, we'll let you head off. So thanks for coming late and providing that update for us. It's very good.
Thanks, Rebecca, and thanks to Mayor Church as well. We appreciate your time today, and thanks to all the elected members and everyone else listening.
Thanks, guys.